Now for some good news at the state level. We're going to talk about the New Jersey Angel Investor Tax Credit Program. This will hopefully equip you as investors and advisors to make the most of this. We're going to explore the structure, eligibility requirements, application, logistics, and some real-world strategies. I'm going to begin by grounding ourselves in the tax credit program and then move through the legislative story that shaped it. We're going to take a closer look at technology and business requirements as a deep understanding of what qualifies as the emerging technology business, which is essential and central to the successful advising. And we're going to discuss who can invest in the benefit and then break down the application process in a little bit of detail. So to get started, the New Jersey Angel Investor Tax Credit is a state program that offers direct, tangible incentive for those who want to invest in emerging technology companies located in New Jersey. That's an important point. The intent is twofold, really. One is to motivate and mobilize private capital towards innovation in the economy and help young companies, often in their most vulnerable years, and to secure the resources that these companies need to grow. The program issues a state tax credit, which is refundable for individuals or usable over multiple years for corporations. It's based on a percentage of qualified investment. The program welcomes both New Jersey residents and non-residents alike, so you don't need to be a New Jersey resident to take advantage of this program, provided that a New Jersey income tax return is filed. So this opens the door to a lot of broad potential investors who wish to take advantage of this. The program was actually enacted going back passed in 2013. The need that it responded to was giving investors a reason to put money into high potential but high risk emerging technology businesses rather than seeking safer, more established alternatives. So this is really more for alternative investment programs. Over the years, legislative refinement has made the program even more attractive. In 2019, the expansion back then effective for applications submitted after January 1, 2020 increased both the base and bonus credits with the aim of channeling capital to areas and entrepreneurs who historically faced funding challenges. The annual cap has also been raised to meet rising demands. I'm going to get into at the end the 2026 legislative changes that affect this program. Any of you who are advisors here, potential investors, should note that the pending bill does increase the credit further. It tightens employee eligibility, so that goes to the 2026 eligibility requirements. In terms of eligibility at the company level, first, the company needs to be actively doing business in the state of New Jersey. It's not enough to have a P.O. box or a nominal presence. The company needs to have a real footprint here: headquarters, staff, property, research labs. At least 75% of all full-time employees must physically work in New Jersey. And for many tech startups, this is a key point. A distributed team with only a handful of New Jersey-based staff may not qualify. There also needs to be an employee cap. Currently, for 2025 and earlier, that employee cap is 225 employees, full-time employees. The law is explicit, and the New Jersey Economic Development Authority frequently asks questions because this program is operated through the NJ Economic Development Authority. There are frequently asked questions on their website which provide a lot of information, and it's very helpful. So what's an emerging technology company? It includes advanced computing, advanced materials, biotech, electronic device tech, IT, life sciences, medical research, mobile communications, and renewable energy. The company's core work must involve qualified research, pilot manufacturing, and commercialization within these fields. Routine software businesses, brick and mortar retail, restaurants, and service businesses do not qualify for this program, even if they use technology in their operations. Again, always refer back to the EDA frequently asked questions for information, or you can give one of us a call after this. Finally, the investment itself must be non-refundable cash transfer or equivalent, and must remain in the company for at least 2 years unless an exception applies. Okay? This rule ensures potential capital for true growth, and that is, I can't stress it enough how important that is. Okay, let's get on to investor eligibility. On the investor side, eligibility is expansive and is inclusive by design. Individuals, estates, and a broad range of entities, including multi-member LLCs and certain investment funds, can participate in this program. Residency in New Jersey is not required, as I said before. If you're an out-of-state resident or even an international client with New Jersey tax liability, those investors may be able to take advantage of this program. If the investor has no New Jersey income, they can still file a state tax return to claim the refund or the credit. Again, refunds are available for individual investors, credits are available for entity investors. The critical logistical point here is timing. The application must be filed with the NJEDA within 6 months of the qualified investment's closing date, and there are no extensions. If you miss this window even by a day, the opportunity is lost. So make sure that as advisors, you're coordinating with your clients to make sure that their application gets in timely. For investment funds, at least 50% of their assets must be invested in eligible New Jersey companies. For syndicate or sidecar vehicles, look to the NJEDA frequently asked questions for guidance and structures. There's a hard cap on credit, which is $500,000 per investor, per company, per year. Larger deals don't generate larger credits. In this instance, both the investor and the company have to separately register with the NJEDA and set up their respective accounts on the Angel Tax Credit Portal. The investor initiates the application within 6 months of the closing date. Once the investment closes, the investor, typically with the advisor, initiates the application. Detail informs the application is changing for 2026, but it's all online. Detailed documentation is required. Proof of funds transferred, signed investment agreements, supporting schedules all are required to be provided. The company will complete its section, which is equally rigorous, unfortunately. Companies must verify their New Jersey presence, submit payroll and employee records, provide narrative and evidence of their qualifying technology activities. This includes copies of W-2s, payroll tax filings, and grant or patent applications, and summary of research and development or commercialization work. Excuse me. The NJEDA's review may involve requests for more information, which is typical of any government agency. Recommendation is respond promptly and be prepared to clarify the company's technology, organizational structure, or employment figures. Currently, the annual cap is $35 million. If that amount is reached before the application is approved, the credit is going to be pushed to the following year. Okay. The financial impact is as follows. For qualifying investments, the New Jersey Angel Investor Tax Credit directly reduces state tax liability, sometimes resulting in cash refund, or for individuals whose credit exceeds their tax due. For corporations, they can carry unused credits forward for up to 15 years. Non-resident investors, as I've said before, can benefit as well. If the client has no New Jersey income, they can file the return and still claim the refund or the credit. For companies, the benefits extend beyond just raising capital. This program helps companies to unlock loopholes of investment, especially for technology businesses. In the early stages, the bonus credit for minority and women-owned businesses is even greater. There's an additional bonus for those businesses, as well as businesses that are taking place in opportunity zones. So there are additional bonuses that go with those. The most common pitfalls that are perceived here are missed deadlines and incomplete documentations. Start early. Make sure that the documentation is complete. Use a checklist to manage the process. If you're advising clients on a fund or syndicate investment, double check with the NJEDA that the structure qualifies. Remind clients that company eligibility isn't static. The business may qualify 1 year and not the next. So make sure that the company does qualify for the angel investor tax credit in the year the investment is going to be made. And legislative changes are ongoing. As I said, New Jersey has legislative changes for 2026 that I'll address in a minute. So let's see what, how this looks. Suppose an investor places $500,000 into a New Jersey emerging technology company that qualifies for the program. With the standard angel investor tax credit of 20%, the investor is eligible for a $100,000 tax credit. If the company also qualifies for the 5% bonus, either for minority or women-owned businesses or businesses in opportunity zones, the total credit increases to $125,000. So this means that the investor's out-of-pocket cost drops from $500,000 to $375,000 after the credit. Now, if we consider a hypothetical investment return scenario, if the company achieves a 5-time exit after 7 years, the investor's gross return is $2.5 million without the tax credit. Subtracting the original $500,000 investment leaves a net profit of $2 million. With the tax credit, the investor's real investment was $375,000, so the net profit becomes $1.125 million. The result is not only higher profit, but also improved internal rate of return. For the advisors in the room, your role is really end-to-end. You take them through the process, guide them on the deal evaluation through compliance and tax realization. Begin with a thorough client assessment. What's their appetite for risk, and what's their state tax situation, and how does this investment fit into their overall portfolio? Okay. Okay. Let's. I'm going to just jump into the legislative amendments for 2026. Here we go. The base credit is going to increase from 20 to 35% of qualified investment made by investors. The tax credit may still receive a bonus credit of 5% if the business is certified as a minority or women-owned business located or is located in either an opportunity zone or a new markets tax credit census. So the total credit then would be as much as 40%. The maximum number of employees, however, is reducing from 225 employees to fewer than 150. And the cap on total cumulative total credits for the year is being reduced from $35 million to $25 million. In addition, the value of any unused tax credits in the technology business transfer program will be added to increase this maximum cumulative total annually. All applications must still be submitted by both the investor and the corporation and are prepared online and are due within 6 months of the date of the qualified investment. Thank you.